You're an elite, right?
Yeah. I fucking
Yeah.
woke up hella late. Like today's my day off, so like I just hella slept in. But I did trade. I don't know. This whole week I just got clapped. This whole week on everything I did.
Oh,
But
damn.
a lot of AMD, a lot of SPY, and it just I don't know. It just seemed like I was right. I was just too early on all my
Bad
plays.
entry.
Yeah, just too early
Yeah,
on everything.
that happened to me a lot this week. Like I
Mm-hmm.
had the right idea, but bad entry, so I got stopped out, and I would have made money if I would have held. But like I respect the stop loss.
Yeah, I fucking hate that, man.
I
Yeah,
really,
I do too, man. But you got to keep moving forward.
I'm a big believer in this. Learning, right? Everybody plays options here. Everybody knows theta. Everybody knows delta. But when you really start to understand gamma and how it's a second underlying movement of how stocks move, and you really understand how gamma impacts a price, it's a game changer when you make entries and exits, right? I don't. I know when to now average in. I know when to add more starter position, add more at the bottom or top. I don't necessarily do as much TA anymore. I'm gonna be honest. I've been trading for like 3 years, but in the last 6 months, 7 months, I barely do any TA. I let the gamma help me to analyze my entries and exits. I have the major psych levels already plotted out. Support resistance. I mean, if I'm a swing trader, I have that nailed down at the higher time frame. But it's been a game changer for me in port size and port playing.
Hold your phone close.
So yeah.
Well, so here's one thing I'll say about options that I've learned because like I started out momentum trading, day trading, and then swinging, and then I spent about 6 months just playing options. So while I will never tell anybody that the Greeks are not important, um, what you got to understand is when you're doing a strike price and an expiration date, the market makers are making those option plays for you. So when you buy into like a call contract, you're buying into the fundamentals of a call. Like you're buying into a strike price that you have the right to buy at that price. So premium price plus stock price is usually going to be pretty identical. So the market makers don't lose money. So I forgot what I was trying to say. But look.
So I know where you're going with it. Here's a simple way to look at it, right? Here's a simple way. I'm gonna break it down in a very simple term. It's like being at a casino. The house wants to have the advantage at all times. Anytime you buy a call, buy a put, sell a call, whatever the transaction is, they're going to figure out a way to make their net exposure zero.
Right.
They want to make themselves risk free
Okay.
because
So-
they want the advantage at the end of the day.
Absolutely.
Right? So if you buy a call, they're selling you a call. By selling you a call, they're going to hedge it by selling shares in the market with an equivalent delta to counteract the gamma movement of the option price if it was to go up.
Okay, exactly.
The more call
Yes.
buying that occurs, the more share selling that will occur. Now, here's a concept that's going to blow everybody's mind, and if you're going to think about it for a second.
Oh, blow
Here's
my
a concept
mind.
that everyone's going to blow it. The Friday's OPEX move on 318, that entire run-up, not a single call was purchased. I'm going to say that again. Not a single call was purchased. That entire move was simply puts expiring, being unwound, and share price going up, and the puts getting destroyed. That's it. That entire bull run move was up. Why I saw that coming? Because of the amount of put volume that was shredded or accumulated below the current stock price that needed to expire worthless. And in order to expire it worthless, the market makers are going to do a counter move so they get burned and they
Right.
make the money. And they're
Well,
going to
wait.
do
So
that by running the stock up.
So let me get it
It
straight. So
sucks.
you're
What?
saying
So
you're the
all I
you're
did
seeing.
all I did on Friday open, I blindly bought calls, closed my eyes, and went and played basketball. I woke up at 3:30. Not woke up. I came back to market at 3:30 and was chilling. That's it. That's the end of the
So
story.
are you
What's
looking at
what?
open interest on those puts, and that's how you knew there was all these puts getting expired, or what?
No, so the open interest on puts, it's tricky. That's a level to help you understand where things are built. Oh fuck, I got a traffic jam now. Hold up a second. All right, so that's the way to help you how things are building up over time. So people use that for like flow analysis to understand where, say like, hey, a lot of people are hitting Apple 165 puts for next week. Maybe something's gonna happen, right?
Yeah.
Cool, but it's not just 165 put. It's a 165 call that builds into it. It's a 164 call that builds into it. It's a 163 put that builds into it. So it's an overall calculation of a profile. Gamma is created as a profile. That's the way I look at it for an underlying ticker. When you
So
build the entire profile for a stock, you can kind of figure out where the maximum resistance is going to be for the market to be liquid and where the floor is going to be for the market to be liquid. When the market is not liquid, you can see that with higher VIX and VXX and higher volatility. I'll repeat that. When the market's not liquid, it's higher volatility, which is why you
right.
have those $6, $7 SPY moves in a day.
So I'm
There's
going
no
to try to get
liquidity.
this thought out while it's in my
Yeah,
head because I've been drinking. Um,
go ahead,
uh,
Zip.
so there's two things that I look at with options. Okay, so the market makers try to keep it at a price to where if you buy into an option, now we're all buying into options most likely because we're looking to sell the contracts for more money than what we bought into. We're not looking to exercise them, most of us. The market makers are trying to keep that price to where it's even to where if you pay the premium for the option and exercise the call or the put, whatever it may be, that the money equals out. Like that's where they're trying to keep the premium price. So they're not getting hit on it. The other aspect of that though is once they open the option, it's all about the bids and asks of what retail or whoever's buying the options are bidding and asking on the options based on how likely they are to come into the money. But if you look at it overall, the market makers that are going to have to be taking the hits or the profits for buying or selling those options are going to keep the strike price, the option premium to where it equals the price of the actual stock value. And I don't know if that makes sense because I'm drunk and
Yeah,
it makes
I see what you're saying, Zip, but it's definitely a little complicated to explain at first if for conceptual wise analysis. But the way to look at it is over time, everyone is making a transaction. This is the way I think of it. No matter if you're Ripster47, who's a big famous guy, or somebody else like a Goldman Sachs who can buy 1 million of SPY at 450, somebody on the other end is receiving your transaction. And if the house is receiving a transaction, they want to limit their exposure. So they're going to do whatever they can to, one, they're going to accept your transaction because they're not going to say no. But two, they want to make sure that their exposure is as minimal as possible. So
right.
they're going to hedge it, right? So that's the way Gamma gets built over time. That's what I look for now. I look for that because that's my way of knowing where house money, that's what I like to refer to as, where house money
Okay.
is being built.
Hey,
That's what I look for.
real quick though, explain to them what gamma is.
Explain the idea or the concept?
No, well, everybody knows delta theta.
Yep.
If you're going to talk about gamma, explain to them what gamma is.
It's basically the convexity of the derivatives value.
So,
I mean,
okay.
another way to say it
So-
is gamma is just, gamma is a rate of change of an option or delta or whatever you want to call it, right? For a single point move in the delta's price, it's a second derivative. So that's
All
what
right.
gamma is referred to as. It's a second derivative.
So let me dumb it down a little. So most people, if they play options, should know that delta is the price that you will make for every $1 the stock price goes up, correct? And theta is the price that you will lose for every dollar that every day.
Correct. Theta is
Every
every
day that
day.
you're in that
Delta is a profit you make. Theta is what you lose every day.
Right.
Or
So
that you have.
gamma is if the option is going in your direction of whatever option you buy, after the first dollar, the gamma adds on to that. Correct?
Well,
That is correct. The gamma adds on to as you get closer to the prime
As you get closer
spot,
to your strike price.
Yeah, right. As you get closer. So when I do option trading, I look for an entry with the lowest delta and a high gamma move. So meaning if Qs are at 353, right? People can get a 354 call, 355 call and be like, yo, I'm gonna make my 20-30%. But the way I look at it is if I see a target, a wall, a gamma wall building at 360, I'm getting a 359 call days out. Because eventually it's going to make its way there. And when it makes its way there, it's going to be worth a lot more.
No, and I agree with everything.
I target the low delta, high gamma.
No, I agree with everything you're saying. You're saying it perfectly for people that already know what you know. But I think there's a lot of people probably in the space that really don't understand the way gamma works.
Yeah, I'm trying to figure out a way to dumb it down.
Gamma's just
gamma's
the spread. Gamma is the spread between gamma is the spread in delta divided by the change in the underlying price of whatever futures contract or etc. That
dear, you're not making it any easier. I guarantee you. Like you just made it more complicated than he did.
No, it's not that difficult. So like if you have
look, when you're learning how to play options, it is that difficult if you're not used to playing them.
Yeah, so like just think of it this way: you have an underlying contract. Let's say it's 200 and the strike is 200, right? The options delta is then 50, right? And the options gamma would be 3, I think. And so if the futures price moves up to 201, the options delta changes by 3 percentage points, right? Because that's the spread. If it moves down by 3 percentage points. So you get a move from 199. The options delta is 47. That's all you.
Okay, so here's what I'm saying, dear. Like, you obviously know more than I do. I know how gamma works, and I don't understand what the fuck you're saying. And I'm not meaning that to be insulting, but like I know how gamma works because I've played options for long enough, but I don't know what the fuck you're saying with the words you're putting in.
Wait, Zippo, what type of trader are you? Do you do swings or you do scalping or what?
Well, I mostly do options, but I've gotten back into swings now that small caps
but Zippo,
I
think options are very hard to explain outside of explaining the mathematics behind options.
Yeah. Like I feel like
hold on.
I feel like
he's putting up his hand. Does he have a question?
I feel like you're a college teacher teaching kindergartners.
All right. Hey, Bill J, you got a question real quick? What's the question,
don't
bro?
get me wrong. I'm a kindergartner.
Yeah, I think Zippo, I'm all with you, bro, all the way. To A stocks, I think I'm just trying to attend the street light class tonight, and most of the nights, like when kids don't have light at the home, they go to the street light and they study there, right? So please educate us, like in that openness, in more details. Like, is gamma really that predictable?
No, it's not. It's very high microstructure. I mean, it's a general way of looking at the market, but there's you have to dig a lot further. It's like low level microstructure.
You can't
microstructure, and I don't know what that.
You can't figure this out just looking at option chains and looking at numbers and putting it together, right? I used to do it mathematically with an Excel sheet because I was a quant guy and that was my background. I used to build formulas. Stop doing all that shit, right? There's platforms out there that you can pay for that do this shit for you automatically.
Right.
You just punch a bunch of tickers and it spits it out for you. You can pay for it. It's worth it if you like to invest and learn in it. I'm sure you can search and find. There's a lot of stuff out there.
No,
That,
sorry, Zippo, to cut you out.
No, go ahead.
Not at all. Like, I mean, anything out there, trust me, I have a lot of experience bedside, and few folks knows here as well. I don't see any predictable signals. Trust me, like if you're talking about gamma, tell me when the inversion happened on SPY. Did your gamma tell you that is gonna happen? That's my question.
yes.
Okay.
On 318, we're leading into OPEX. Gamma was telling me that we're going to have a bullish run and we're going to run and everything that's below is going to cause the upwards momentum. I knew that walking in. I did not think puts. I did not think any downward momentum. Now, if you were to ask me this past couple of days, we're going to continue to keep going up. I could not have predicted that because gamma is still being built into the profile based on the data that I have. I could not have predicted that. But walking into 318 into OPEX, I knew that. And I wasn't the only one who knew that. There was a lot of other people who read this shit were saying the same thing. And so we all did the same momentum play.
I love what you're saying. And I really do. I love what you're saying. Because I'm not a real experienced trader, but I've been playing for a year or so, and I've played options for the past 6 months. And what I would tell everybody who's less experienced is, okay, research what delta, gamma, and theta is, and then
learn to build a Garsh volatility model.
Right, but when you're starting out playing options, I think a really simple way to say it, no matter what the Greeks are, understand what they are and understand that they can make you more money one way or the other. But how likely, if you're playing a call or a put, is that contract to go the direction that you're saying it's going to go, that you're betting it's going to go, and if it's going your direction, take profits along the way. Like most of the time, if you're in a close strike price, if it's going if you bet a call and the stock is going up, the contract is going to go up because it's more likely to go into the money. The most likely it is to go into the money is the more the strike price or the premium will go up on your contracts, which means the contracts you own will be worth more. So just like focus on that when you're starting. Understand what the Greeks are, but like the more likely your contract is to go into the money, the premium will most likely go up.
Yeah, absolutely, Zippo. And